For those of people who aren't that familiar with multi-counselor, effectively you have 4 on the stable fund and the value fund. You have 4 sleeves of assets that are managed by different people. All those people are on the same investment team, talk daily, by the minute even on investment issues, and think more or less in the way Ford Asset Management wants to run money.
For Ford Asset Management, we have a very collegiate style, very flat structure. Everybody talks to everybody all the time, and we talk, anything interesting pops up. We either talk on the phone or we talk on the email and discuss things, and we set up meetings. If something becomes a debatable point where we've got different views, we set up a meeting and we debate it with as many people involved as want to be. So it's very collegiate style, very open. Very important to discuss these things. That's how the team learns. That's how the team learns the philosophy and understands the Ford way of doing it. You need it to pervade, you need it to spread. It's not a manuscript that people need to learn from. It's something they absorb by osmosis, by watching it happen. So every manager, every multi-counselor manager can invest as soon as he wants to. It's recorded, it's open, we all see it. There's no secrets in the team. It's part of how we do things differently. We debate things, but when it comes to implementation, it can be done straight away by the manager. That's important because it weights the change. As consensus slowly comes through and the rest of the team agree with the opportunity, then we start to upweight and get more of something with consensus, and the same the other way around. If somebody doesn't like an item, they sell it. And then others join. It actually doesn't become you've got 4% in a particular stock and suddenly you've got none. You move gently in the right direction. So multi-counselor works in lots of ways that way. It also gives stability to the team. If anybody's off or sick, there's other managers there that know what's going on in the fund. And the diversification of multi-counselor really works, and it's an education process and a discussion. But it also needs to be managed. Multi-counselor per se doesn't work. The individual needs to be independent-minded. It's no good having 5 multi-counselors if they're all thinking the same way. They need to think differently. And that's part of what we've done with our team, is build up people that are independent-minded and have separate ways of thinking and doing things.
It's a fine balancing act because you want to give people autonomy and the right to make decisions. But you also need to make sure that they are thinking through things properly and in line with the way you have set up the asset management business. Is there any checks and balances that happen there, or what?
I'm the risk manager. I get to see every transaction as it happens. If there's something that's happening and I don't understand, most of it I understand because we discussed it beforehand. But if something's happening or waiting's not quite there, I'll discuss it with the manager, and I need to get the proper understanding of where he's at. But I will come in and say, no, your weighting's too high. So I won't come in and say you can't hold that stock or whatever. But I will come and say for that sort of risk, the way you're describing that risk, I think your weighting is too high in that item. Maybe it should be a 2% holding and not a 3% holding in the portfolio. Things like that happen.
And we talked about the portfolio managers there, but not many people realise that you've got a bank of equity analysts dedicated to researching local companies, which is very broad and diverse, as you mentioned. How do they interact with the portfolio managers and get their ideas into the funds?
Well, let's start with the portfolio managers. Portfolio managers also need to be analysts. And then underneath that, we've got a bank of analysts, and the analysts are split according to economic sector. And the reason we split according to economic sector is because that's the main driver of the earnings, is the economic sector, and the main driver of diversification. So the diversification is a very important way of managing risk, and so the sector is there. Now the analysts here and the analysts in Singapore are allocated sectors, and we need 2 people on every sector, and their maturity will change. And the way analysts think also changes, in the style of people that we employ. If everybody's thinking the same, then nobody's thinking. So we want people who think outside the box. People who are poor, hungry, and determined. So we're looking for PhDs to be analysts. And the interaction between the analysts and the portfolio managers there all the time, because the portfolio managers themselves are analysts. and taking sector responsibilities. And we get in obvious things like telcos, we get ideas from Singapore into SA and from SA into Singapore. And we send analysts to Singapore for a period to study the sector globally so they can get a feel for how valuations work around the world. And of course they ultimately come back into SA because a lot of our market is priced from offshore. So we need to understand things like that. So there's a big integration between the analysts and the PMs, between Singapore and SA. Both the Cape Town team and the Singapore team meet telephonically every day, and portfolio managers have to be there. Analysts can be there out of interest, or particularly if they've got something to say or contribute, they need to be. And we talk about macro changes and micro changes. Focus of the business is on earnings, on the selection side. So we want to know what's happening about earnings. We take a longer term view, and that's ingrained in everybody. We started off early on, it was as early as 82, 83. We looked at managing by committee, getting consensus.
Yeah.
And we found that getting consensus, it's a slow process, and most of the initial move can be lost while you're getting consensus in the committee. Because while you're getting consensus in the committee, the market's already waking up to this opportunity. Right from day one, portfolio managers could make their own decision and implement it straight away. And we've kept that. And as we've got bigger, we diversified. And again, there's that free lunch of diversification. By having several managers on a fund, we get that diversification. And the people need to implement straight away.
And I think you've got a range of experience within your equity analyst. I think it's 8 analysts at the moment. How do you assess their performance?
They are scored in lots of ways.
Yeah.
They have their portfolio on their sector. They have portfolios outside of their sector, which they're not allowed to change for a year.
Right.
So they've got to take a long-term view on those. And they can change their portfolios within their sector whenever they want to. And we score them on the alpha generation on their portfolio versus their sector.
Lastly, on the team and the process, there is a question on your regular meetings. You mentioned the daily meeting, but what other regular meetings do you have as a business and that are essential for running the portfolios?
Cool. We also have a top-down angle. So from a macro viewpoint that feeds into the asset allocation. We've got a macro forecast that we debate and update. And throughout our history, we put down parameters around our forecast. And if the actual print starts to move outside the forecast, then we redo the macro forecast completely. And all the PMs get involved in that and debate that. And so it's not set on a calendar basis. It's an event-driven thing. So if things are stable and our forecast is panning out, then we might not change it for 4, 5, 6 months. But the world's not like that, and our forecasts don't always pan out. And we put sensitivities on the most important variables, and if the variable starts to move outside our forecast range, then we redo the entire economic forecast. And then on sectors, there's regular monthly meetings within the sector team, but on a 2 to 3 month basis, there's involvement with PMs on lots of attributes, looking at some quant factors and then looking at forecast factors and looking what other people are doing in terms of forecasting earnings, because earnings are very important to us in valuation. Earnings forecasts are much more important to us than the PE multiple or anything like that. The current valuation, we really want to get the earnings right, because ultimately earnings determine the long-term return of companies. So we spend meetings discussing earnings and the sensitivity of earnings. So we put bull cases on and bear cases on and discuss the parameters and discuss the assumptions that are going into the top 10 market caps in each sector, as well as the stocks that we're looking at in our fund, and looking at stocks. We also identify stocks that we want to be in, but we find that are expensive. So we put them on a watch list, and we discuss those which should be on that list and which shouldn't be on that list. So there's a lot of meetings, but not necessarily set meetings, because meetings can be a waste of time.